Welcome to our monthly webinar where we are talking all things data, all things markets for the month for Nest Edge and how we're looking at things. So we named this the Nest Edge because it is our way of looking at things and how we look at the data to make sure that we're look at the markets differently. This, as a disclaimer, is not advice. It's an educational webinar. Use this education for making informed decisions. And again, this is how we look at things. In this game of investing, there's many ways to win, many ways to lose. And this is just our way of how we do things. And we're discussing our process. For those of you that have listened to our webinars in the past and would like to move forward in building your portfolio, please reach out to us at info@nestfinancial.net. We'd be happy to walk you through the process. I also recently read a few months ago where every one of us knows 152 people. And so on average, so if someone in your circle needs knowledge on finances, please invite them to our webinar. We'd be happy to include them in our discussions. Today, we have a different format. We have invited Becky Henderson. Becky, say hi.
Hello.
So Sean and I and Becky will be discussing. Becky is a long-term friend of Nest and also a client. And recently her and I were having coffee and she had some questions just about how the markets are acting at the moment and what she should be doing and concerns, even though that we are managing a portfolio, there are still concerns out there. So I said, why don't you come on the webinar and we can discuss your questions and give some answers, because we're sure if you're having these questions, other people are too. We want to make sure we're transparent and are getting to those answers. So that's the purpose of the webinar today. Sean, welcome. Good to see you.
Hello. Good to see you.
So let's just get this started. Becky, thanks for joining us. And love to kind of start going down the path of your questions and kind of why those questions are coming up for you.
Yeah, thanks, Dan. I appreciate being able to get on the live show with you guys and have a conversation with both of you and to get your feedback on this. So my first question, it's regarding I would say the near term, like over the course of this year, outlook regarding the market. I have some concerns that there could be a significant correction. To what degree, I don't know, but some of the folks that I have been learning from are speculating that there's significant correction on the horizon. So first question is actually twofold. One, is that what Nest is seeing? Sean, is that what you're seeing? And if the answer is no, I'm curious to know or to hear more about how you're seeing or what you're seeing. What are the indicators that that's not likely to happen? And if your answer is yes, that is what you're seeing. What's that?
What and why?
well, and beyond, what, why, and the additional, how are you currently positioning the portfolios in relationship to a potential significant correction?
Okay, so I'm going to caveat, when you say market correction, are we talking equities domestically?
Yes.
Okay. We are of the thinking that there is a significant correction if we're not, we're entering this earnings season is going to be probably pretty violent.
Let me stop and expand on earnings seasons for those of you. A lot of times we use jargon because it's just, at the end of the day, every company has their own way of talking about things. Would you elaborate on earnings season for those that are listening?
Every single quarter, publicly traded companies have to report or at least say something about how things went in the previous quarter and give forward guidance, which is, what they think is coming down the pipe in the next few quarters. So right now, today started earnings season. Finance and specifically the banks are going off right now. JP Morgan went off this morning. And so all the data that they're giving is for what has already happened, Q1. We know what that's going to be within reason. It's the forward guidance we're most interested in, and that's where most of the attention is going to be. It is our beliefs that we are walking into this quarter compared to where we were a year ago. So we won't actually hear these numbers for another 3 months, but we'll get forward guidance on it. We're walking into the most uncomparable comps we'll probably see in our lifetimes. So it's going to be next to impossible for us to beat what we did a year ago. So that is not set up well. The street is not positioned for that. There are some people out there that are aware of that. But then a lot of them, I'm not going to go down the rabbit hole because there's like a billion different rabbit holes on this. But short answer, yes. Domestically, equities, depending on which indice you're looking at, we're down year to date 7.5% to 14%. So everything is underwater right now. And the S&P got down to around 12 or 13, maybe even 14 underwater at one point. I think we'll test those lows again.
So just as a again definition.
Am I getting too target heavy?
Do it.
Am I getting too target heavy?
Always, but at the end of the day, I give myself permission to be the dumbest person in the room and ask the questions, because at the end of the day, that's important to get the very simple questions out of the way. But when we say comps, one of the things is we're always comparing year to year. So when we're doing a quarterly comp, so why earnings season is important is because what these people come out and do starting today is they say how they're doing for the quarter compared to last year, and why that's important. I know we kind of skim over it because we're in the weeds all the time, but last year comps, because we just came off of COVID, everything looked super rosy, rosiest we've ever seen.
Numbers were ripping.
And so now if you're comparing to the super rosy, then it's not going to look nearly as good. And so that's just brings this negative sentiment because we're comparing to an unfair place is what it means to. I just wanted to explain that. Yeah. But Becky, hopefully that answered at least one of your questions.
Part of it. I keep getting too jargony. I keep being told to shut up. We anticipate things to get worse before they get better. We are positioned for things to get worse before they get better. We have, in all of our models, we have zero domestic equity exposure. We have currently some South Africa, some Indonesia, but we have very little equity exposure right now. What we're doing in the short term to address that, we are very heavy on US dollars, gold, and treasuries. So our boat is made for the volatility right now. Does that answer those three prongs? I answered all three of those.
Mm-hmm.
Becky, feel free to add to your questions. If not, I'll jump and supplement some of those questions.
No, go ahead, Dan. That's what I had asked has been answered from me.
Okay. Yeah. So, Sean, I want us to elaborate a little bit about why the two places we have equities, the two parts of the world we do have equities, and then I want to elaborate on the things that we are in our portfolio. Like, why is that a protection?
The second part is going to be real hard to explain, other than a short answer. The first one is pretty easy too. It's economically, they're in a better position than where we are. We have seen this trend of where you are on the COVID curve. Like basically whether your cases are accelerating or decelerating is kind of how your economy has swirled. Europe is 6 months ahead of us. And then those countries economically are just in a different place than where we are. Like their harder comps are later in the year. So they are still accelerating. So we're trying to take advantage of their positive economic outlook right now where we stand. Why we like gold, US dollars, and treasuries. The short answer is it's a flight to safety thing, if that's the shortest way I can explain that thing. There are some nuances to it, but the straightforward answer is when people get scared and they don't know which way is up, they run to gold, they run to US dollars, and they run to treasuries.
And the second part of that answer, just to elaborate, if we're already there before they're there, prices go up, we take advantage of those prices and then we start selling. So we always sell into, when people are coming towards it, we start selling to it and making those
perfect world. You always want to be where people are, you want what everyone else has. So you want to be, a month or 2 or 3 ahead of the curve. You want to be standing where everyone's running to, and then you can exit stage left when everyone has woken up and, is standing around you. You don't want to never be with the herd, never be with consensus. You will get whacked.
And that's a technical term, Becky. Whacked.
That whacked. That's some jargon as well.
It is on Investopedia. I'm going to go add it real fast.
All right, Becky. So hopefully, did that give you the roundabout on the first question?
Yeah.
Okay.
Yeah, and so my second question is connected to it, to what Sean you were just saying about, we want to be positioned where others, we want to be positioned there before the herd is then wanting to get there. Yeah. So connected to that is during a significant correction, is it possible that the portfolios are going to be making money? How likely is that? How does that work? And then is it very possible that the portfolios are going to be losing money, and how so? And we're talking specifically in a correction in the equities market.
Okay. Yeah. It's always possible that you make or lose money. Let's get that announcement out there. But in regards to making money when equities are down, most of our models will not, because they won't be in equities, or very little. We do have one model that has
losing money.
Yeah, losing money. I mean, if you're not in equities, you're not going to make or lose anything. We only have one model that is allowed to short. It will make money in down markets. Currently, it's down or short financials. So. But the immediate radar, I have about 3 other things that I'm looking to short at the right price. It's not there yet. So if equities crashes, that one model will do well, but it's the only one that's allowed to short, excuse me. If equities do crash domestically, our other positions that are in different, that's why we trade in 4 different silos, 4 different, pools is, we're paying attention to currencies, commodities, and also bonds. So we were going to be in the other places, where money is going to run to. So if equities are crashing, unless you're short something and you're only in equities, it's not going to go well for you. But that's not what we do. We're not, long only, equities only.
So I want to expand on that, Becky, a little bit, and Sean. I want to talk about the 4 markets because I think that's super important for people to understand. One of the things that you and I were discussing, Becky, was a lot of times when people think about investing, they think about stock market and they think about equities, which is one of the equities. I mean, one of the markets that we can invest in. At Nest, it's only, so I'll back up. For many advisors across the world, that's where they focus, and that's why it's known that way. For Nest, we're different in that we focus in 4 markets, and that's highly important to understand. Sean, will you talk about the size of the different 4 markets so that people understand the differences?
Like a moth to the flame, equities is all, when I hear markets and investing, that's all I think about is stocks. It's the fun, sexy toy, but it's only about 1/3 of the size of the bond market. Bond market is the big gorilla, and it's only gotten bigger in the last decade or so. Currencies is probably somewhere in the middle, and then commodities is the smallest guy out there. It's just not as much volume, and most people don't understand it. So equities compared to bonds importance, it's not even close. If you're not paying attention to the bond market will tell you stuff way sooner than the equities market was. The equities market had like this this is a uniquely American thing as well. Like, so there's equities, there's domestic and abroad, and they all kind of have different traits. But we're just like drunkenly, inherently positive. We always assume everything's going to be fine. Some of that is because the financial space needs things to go up. Too many people can't make money in down or sideways markets, so there's this bias to everything's going to be fine. Keep buying. And a lot of it is how our passive investing, 401ks, also do kind of help that along. Don't if you underestimate passive investing, you're probably missing some of the colors and the fine print. So all that being said, I feel like I've lost my train of thought, but the big thing is
4 markets.
4 markets. Bond markets, way bigger, way more important. It will tell you things way sooner. More sophisticated traders are generally in the bond market. That's where you will, like you heard me and Dan talking about have seen some weird things in the treasury markets the last few weeks. And I only caught wind of that because of a guy that lives in the derivative space was talking, on Monday. And I like, it's very in depth and it's pretty wild that this guy caught this. But those are the types of things that you need to, if we could see those weeks in advance, like, okay, something's coming, here we go. It'll give you a heads up sooner than the equity market. Equity market largely is, a bunch of goofballs running around with their hair on fire. Like, it is wild. Like, there's so much weird shit that happens on there. But they'll be like, hey, why is Tesla doing X? I'm like, I don't know. There's 30 to $50 million retail investors out there all of a sudden the last few years. So like, it's never been even wilder. So there's a lot of, the meme stock craze. All of this is based on a lot of people that are new to this. So there's going to be a lot of wild movements and volatility. So,
So I want to bring us back to the four things. What I was trying to highlight for Becky is the big difference is there is the four markets, and when Sean puts this in many of our webinars, he said we just get out of the bus. We get out of the movie. The bus is coming. We just get out of the way. And what that means is, if to your first question, we think that the equity markets is going to have a correction, we just move the assets out of the way into some of the other things.
Yeah.
But generally speaking, when we talk about the quadrants that we are looking at as far as where the economy goes, there's always somewhere someone's making money. And so we just want to make sure that we're moving the assets to that quadrant and in the types of vehicles that will make money in that space. So to put a nice bow on it, Becky, yes, we do think there's a correction coming. Yes, there is. If we're going to be in equities, you will be harmed. We've moved out of equities, but we're moving into other things that should do well in those markets. And yes, there's always a possibility of, even if we're in these other spaces, for there to be some harm, because there's always surprises that happen. But typically, you're more right than wrong, because we know what the long-term direction is. Sean and I were talking about this yesterday, and he's like, where the highest volatility is in the next week to 3 weeks. That's the hardest part for us to be able to see what's happening, because there's all kinds of things that can happen. But the duration in the next 3 months, it's much easier to tell where things are going. And so if we just have that patience and say, okay, next 3 weeks might be a little volatile, sketchy, but the long term, which in our view, the long term is the next 3 months, the next quarter, this should be the place where everybody's running to, and therefore our portfolio should do well over the next 3 months.
Yep. Next 3 weeks is going to be a wild card. The biggest thing, and I was telling Dan, the Fed has, not surprisingly, become very political and agenda based. And I wish they would shut up and talk less. And, I don't care what they say, it's what they do. With the inflation CPI number that came out, I think like the rate hike expectation fell from like 9 to 8.5 times this year, which is insane. I think at most they do 2, maybe 3. At 4, the financial system in the world breaks down. So that is the biggest curveball, is what they say and do.
I'm going to ask Becky, did you understand what he just said about the rate hikes?
Yes. Yeah.
Okay.
Yeah.
So they're looking at 9 of these.
That's what the futures market. So without getting too deep into the weeds, the futures markets have this mechanisms where they're pricing in and guessing how many times the Fed is going to increase rates this year. And that number fell from like 9 to 8.5 today. But like, I think looking back 2-3 quarters, when we look back and see that, the Fed futures rate got up to like 9, is going to look like bananas. The Fed will blink. And again, I don't know. I'm just giving my opinion. They'll break, they're going to do 50 bips next month, and they're going to attempt to do another rate hike after that. And I think the equities market will, Powell is a private equity guy, and he has a phone directly to those guys. And if they're getting pissed because their investments are going to hell because they keep increasing rates, there's going to be a direct line there. We'll see what happens. I think at most we have 2 rate hikes this year. I think things will just go sideways and fast. Equities after this earnings season, I think the picture will change dramatically, and the Fed will start to, they're annoyingly backwards looking. Like they drive their car looking through the rearview mirror, if that makes sense. They're just like completely unaware of forward looking data. Or they're aware and just don't care. I don't, the Fed does a lot of things that surprise me often.
So I want to, in the interest of time, Becky, I want to get to your next question.
Oh, yeah.
Make sure that we're getting everything. Because all this is good information, and I want to put a bow on some of the stuff, but I also, know that we've got to be respectful of people's times out there.
So, Dan, you mentioned there's always a possibility of surprises. If there was a scenario where all of the four vectors were impacted simultaneously by a market correction, what would be the pros and cons if I was anticipating that could happen? What would be the pros and cons of taking my money out of the market altogether, out of the market, out of the banks, put it somewhere where I think it's safe to wait through the initial crisis and then put it back in afterwards?
I have an answer for that, but Sean, do you want to?
Oh, yeah. Again, we only have 8 minutes here. Jesus.
I know. We'll have to do another one of these.
This question is going to be, I'm just going to warn everybody. I'm going to let Sean loose. Go, Sean.
That's a bad idea. I'm already chewing up too much time. The short answer is, so the question is, if all four areas that we're in that we pay attention to, if like somehow everything goes sideways and everything goes down, why not yank all your money out? The short answer is 30 to 50% of all of our models are already in cash. So we are very defensively postured. And I would tell you, if things went totally sideways, it's exactly when you want money in your account. Because that's when things are like, when you want to start paying attention to when things start bottoming. That's when you need to start jumping in. Taking cash and putting it in you're always going to tell yourself why it's not time yet to put the money back in. Whenever we see people do this, I haven't seen people do this in a while because we're pretty good about talking like, look, just breathe. Everything's fine. We don't have the kind of volatility that you do see in the domestic equity market. So this doesn't come up a lot for us. But I will tell you, it's the worst possible time to start yanking money out when the volatility rises. That's when you should be adding money. And the odds of all four of those, the things that we're heavy in, dollars, gold, and treasuries all going down or all melting down at the same time, I would have to really think about a scenario that would cause that. I don't know.
Let me add something to that because I think that's an important distinction to make. Becky, if that was the situation, the money under your pillow wouldn't be worth anything. So it's because, as Sean pointed out, we're in gold and treasuries. The safest thing in the world is treasuries. I mean, it's just because of the taxing power of the U.S. And then gold is second. That's why we're in those things. But when people have this doomsday scenario in their head, you got to think about other countries where their currencies just fail at that point in time. So we don't see that happening. And we're not saying that's going to happen, but if we were going to play this game and say, let's go down the scenario, you wouldn't be any better off with money under your pillow. As Sean pointed out, most likely what will happen is in these corrections, in one area will happen, we'll be in another area. And then when that crashes, we want to move that money quickly into the places where all these things are on fire sale, because that's how you're going to make a lot of returns in your portfolio is buying really inexpensive, good quality equities when they're priced right.
You want to get greedy when everyone's scared and get scared when everyone's greedy. And the thing that's gotten me nervous lately, I swear every time these hooligans do this, whenever there's when I start hearing this time it's different, I'm like, oh God, I want nothing to do with that. Because almost always it's not. It's just, they got to peddle their story to sell their wares or whatever it is. But I've been hearing a lot of, even the New York Fed came out and said, yeah, we know that the yield curve inverted, but this time it's different. I'm like, the Fed is saying that? Oh, this is crazy. The same Fed that said a year ago that the inflation's transitory and then now it's not. Now you're going to give me advice on what the yield curve means or doesn't mean? Thanks for coming out. Go away. You guys are so. One
thing I wanted to add to that, Becky, is just understanding, and we've said this since day one, that most sources where you're hearing things from is going to have some sort of bias. So all the media channels, all the financial channels are being paid for by some commercials that and outright ownership. There's it's come out that a lot of hedge funds and a lot of these big financial companies, banks, own a lot of these media companies. So they put spins on things, and it's illegal to do, but enforcement hasn't happened. And so at the end of the day, we have to take everything that comes at us in the financial world with a grain of salt, even the numbers that come from the government, because those also have political, a lot of times they have political sway. And so our job and why we go buy data on an ongoing basis from the most reputable firms is because we want to cut through all of the noise and get to the real data, and then make decisions based on that real data. And that's the difference between the doom and gloom. Here's all the things that are happening, and yes, there's some truth to that, but what's the motive behind it? And then getting the real data and saying, okay, here's what we've seen historically happen, and here's where we're going to be positioned going forward because of what we're seeing real data. So I just want you to keep that in mind whenever you're hearing things, and also the audience out there when they're hearing things. There's just so much stuff that we look at and we're like, oh my God, really?
I try not to look at it. Yeah. The only time I look at it is when clients send it to me and want my opinion on it. I'm like, oh, whoa. Yeah.
Okay, I think we've got time for maybe one more question. If you've got another question.
Okay. Yeah. So last question. I'm curious as to your understanding of how precious metals behave during an actual market correction in let's say equities. My understanding is that they have historically spent some measure of time going down as well before rising sharply in the aftermath. But I'd like to know what your understanding is of that.
The answer is it's always a little different. And it depends on where we are in the business cycle, where we are in the earnings cycle, the credit cycle. There are nuances, and they don't all trade the same. Gold will behave a little differently than silver. Platinum will behave a little different than silver. And so there are different nuances, but the gold's probably the one outlier in all of those, and that it's a flight to safety. It has people view it as a unit of exchange, which I do agree with. I view it as money more than I do a commodity. But you can argue it's a commodity. I don't care which side of the fence you're on. But of all of them, gold does better in those environments because of flight to safety. Now, that's a very overarching answer. There's always differences, and there's nuances and correlations that exist and that don't exist. So it's always a little different. But the short answer is if it's hitting the fan, you want gold.
Okay.
As
tight as I can say that.
Yeah. We discussed this, and I think the main thing is as Sean alluded to is there is some correlation, but not in every instance. The flight to safety is definitely things that people think about because of the gold standard. Is let me go to, and it's just this reasoning of put money under my mattress or go to gold, and so that's why that's why that's different than other precious metals. But as Sean pointed out, if you're and that's why you also alluded, Becky, as to sometimes at the beginning of the phase, it goes down with the market, then it comes back strong later. And it's just that time it takes to move for people to make those decisions and move money to flight to safety is what you see. That's one of the big answers, not the only answer, but that's one of the reasons why you see that delay.
Precious metals have a tie-in with industrials. That's one little, and if the economies are slowing, industrials are slowing, therefore input costs the demand falls for them. So that kind of causes a lot of precious metals to cool off. Sorry, take over, Dan.
No, and I was just going to point out, you also said that once the markets take off, you see this delay in gold still rising. And that's also to one of the things that Sean mentioned is because of the delay in people's reactions. People will tend to sit in cash and gold longer and just kind of wait it out and see, is it really rising? Is it really rising? Is it really rising? And then they'll tend to miss the first 10 to 20% of that equity rise and then jump in. And so you'll see that variation in gold prices sometimes because of that delay. It's a whole flight to safety thing.
Great questions.
Yeah.
I could talk about this for a day, so that's as fast as I can pump those answers out.
We're about 20 seconds over our time. Thank you very much, Becky, for jumping in.
Yeah,
and
thanks,
asking
guys.
some
I really
questions.
appreciate it.
Yeah. Thank you all for joining us on our webinar. Hope you learned. If any of you want to come on and be on the show, we'd love to have you. Our goal is to be completely transparent and answer as many questions as we can based on the knowledge and education that we've got. So be happy to have you on. Enjoy the rest of your day. Take care.
Adios.